this was something that the street was anticipating. NSE, of course, it's an advantage for them. Their pre-market, pre-listing rate may be going up, but BSE is the listed player. What is the kind of impact do you see?
Hi, good morning. I think, if you see last 2 years, BSE's market share went up from almost being negligible to, 20-23%. And that also contributed to, the stellar rise in how BSE is also done as a stock. Even if you see last 1 year return itself, would be close to 200%. So I think there could be some near-term reaction because they could, in the short term, impact the turnover as well as market share slightly. Could vary from 5 to 10%. We'll have to see how it goes. I'm not really a derivatives guy to tell you that. But Tuesday had that advantage of 1 day extra. And so some impact would come. But I think over medium term, I agree that it could readjust. Also, Tamanna, I think just ignore the near-term reaction. I think there is a lot of, FOMO in listed and unlisted space on exchanges and capital marketplace, and people are suddenly giving 60, 80 multiples to these businesses without realizing that they are very, very cyclical, and they are dependent on mark-to-market moves. And for example, derivative contracts, as a significant percentage of the overall revenue. And one soft quarter for the market, which we saw when corrections started happening in October, or maybe let's say 2 or 3 soft quarters, which a lot of retail investors haven't seen, could impact these businesses. So you can't assign that kind of earning multiple. So it's not like banks where earnings will deviate 1 or 2%. Earnings can drop 20, 30%. We saw that even in CDSL, when the earnings became soft, or even in CAMS, because there is an impact of mark-to-market on this. So you just have to be careful we don't get over, that FOMO may not make us, pay such high earning multiples to capital marketplace.
Hi, Gurmeet, morning. I just want to get a sense then what according to you is fair value for BSE if it's trading at trailing 80 plus times, and even if you have a small impact on the EPS on account of this shift, what is fair?
See, I think, I'm no one to assign fair values. The market will decide, I'm too small investor to decide that. But, if you see globally, exchange trade at about 20-25 times. Now, India is, let's say, a high growth market, and we have new investors coming in. You can maybe assign a slightly higher multiple. But to assign 80-100 multiples, assuming market will keep going up and investors will keep getting added at the pace we have seen. So mind you, we now almost have 19-20 crore demat accounts. Maybe unique could be around 12 crores. So yes, we have a high growth trajectory ahead, but it will not be 40-50%, what we have seen post-COVID. So I think somewhere even the growth expectations have to reset. Also, if you see, algos are now making up a big part of the F&O volume. And regulators equally concerned on, retail losing so much money in F&O, especially to these sophisticated hedge funds and long-short funds. At some point of time, even the F&O volumes, which in India are even higher than United States, will also see at some point of time some moderation. Right, so I think any fair multiple should be in a way of, in my view, should not be more than 30-40 times. Even 30-40 times obviously is on the high side. But assigning 80-100 multiples and assuming this will do well for next 5-10 years typically leads to very, short-term disappointments.